Hello friends, welcome to this new feature which we are launching today. And this is extremely unique in the sense because there is hardly any platform in India which gives this tool. I think this might be the first platform in India which has enabled this tool now. This is for pairs trading. As anyone might know, pairs trading is where you typically trade two instruments mostly from the same sector, in which one is the long leg, the other is the short leg. So it is a hedging mechanism in itself and it has a low risk attached to it. But then there are various methods to identify which pair to trade and how to trade it. Second part is when to enter. So that is the second part. And then again the trailing part. So there are again two ways of doing that. One is the trend following way, which of course can be done on the basis of charts which we have in TradePoint, RS and those charts. But that is not what we are going to talk about today. There is another method which Raghunath and his team have developed, which is going to be in OPSTRA, and that targets mainly mean reversion. So that is exactly opposite to trend following, but that also pays well. And in fact, this is a trading setup which a lot of institutions use because they have to control their risk. Unlike small traders where they can be long in one naked futures or 5 lots or even 10 lots. But then when institutions deal in big quantities, they have to ensure that their risk is controlled, and that is why they resort to pairs trading. So this will definitely help even small traders who trade in naked futures to identify a pair, so the risk is reduced further and profitability might increase in some cases. So I have with me Raghunath. Over the last maybe more than 6 months or a year has been developing this tool, and it is now ready to launch. So welcome, Raghunath.
Thank you, AP. I have been working on pairs trading for a very long time, and I always wanted to develop a tool where user can go directly and find what are the good pairs that one can trade, and where they can know when they can trade these pairs and how to trade these pairs. So we are going to discuss what is pairs trading, and then we'll talk about how to execute this pairs trading using a new pairs trading tool that we are going to introduce in OPSTRA.
So pair trading is when you trade one pair, but here we are talking about the concept, which is pairs trading. So
Yes.
that's the difference.
So let's see what is pairs trading. Now let's look at two stocks, stock A, stock B, and this is a price chart with and time on the x-axis and price on y-axis. And here you see the price chart of stock A and stock B, and they are moving along together with slight variations, right? So pairs trading strategy involves trading of two correlated instruments, where overperforming instrument is sold and underperforming instrument is bought, in the belief that their performance will converge. So if two stocks they diverge in their performance, we are going to sell one, the overperforming one, and buy the underperforming one, hoping that they are going to converge and we benefit from that convergence. This is nothing but it's a mean reversion strategy.
So in a way, you can say it is a pullback strategy for both stocks.
Yes. It is a market neutral strategy where pair of instruments are traded irrespective of market trend. So it doesn't matter if you're in bullish market, bearish market, sideways market, you can do this kind of strategy in any kind of market condition, because we are only looking at the relationship between two stocks. So, and whenever there is divergence, then only we are going to do this pairs trading strategy. So it's kind of inherently hedged against one another.
In fact, just to point out here, whoever has been in the market for a long time, maybe more than 5 years, and whoever has contacts with people who are in institutions, one of the very popular pair trades used to be HDFC Limited and HDFC Bank. Another popular trade used to be PFC and REC. These are the two pairs which I know people have been trading for donkey's years. Of course, there is no HDFC now.
Yes. Also, that's also because their correlation is very high. They move together, they fall together. So that's why you would have seen that many people use that. Another one which I remember was Tata Motors and Tata Motor DVR.
Yes, when both were in futures. Yes.
So like that, you should be able to identify those pairs, and you can trade those pairs. So now let's look how to identify this pair of instruments. Pair of instruments, be it stocks, currencies, commodities, or ETFs are usually chosen from same market segment where there is a high probability of high correlation, right? You cannot trade, some unrelated stocks, right? Because they may behave totally in a different fashion to each other. So you have to always try to find pairs within their own sector where we know that they are most likely than not are going to behave in same manner, because they have same market conditions, they might have same regulatory risks or tailwinds or headwinds. So it's better to choose these pairs from the same universe. For example, there's a good chance that you'll find a good pair of stocks for pair trading from within IT sector or finance sector rather than between these two sectors.
Yeah.
Right? So like Infosys and TCS or Bajaj Finance or M&M Finance. So those are related stocks. So one can look at those pairs rather than Bajaj Finance and TCS, right? Doesn't make sense. Stocks in the same sector tend to move in same direction. This is not 100%, but at least 80 to 90% of time, you will see that they are moving in the same direction. Now, the second step in this pair trading strategy, the first one is identification of pairs, right? The second step is we are going to measure three different things before doing the pair trading strategy. One is called correlation, the another one is called cointegration, and the third one called is a mean reversion. Okay. Now we'll talk about why these all are important. So let's talk what is correlation. Correlation is quantified by correlation coefficient between two variables. The variables such as log returns of the pairs. Okay, so you take log returns of the whatever pair you have identified, and then you measure their correlation coefficient. So high correlation means they are behaving in the same manner. If there is low correlation means they are not behaving in the same manner. And if it is like negative correlation, which means they are behaving in opposite direction. So correlation coefficient ranges from -1 to +1, where +1 indicates a perfect positive correlation, while -1 indicates a perfect negative correlation.
So we want perfect positive
yes.
correlation. Yeah.
Those are the better ones because we know that they have same behavior. So a perfect positive correlation is when one variable of the pair moves in upwards or downwards direction, then the other variable also moves in the same direction with the same magnitude. So the price or the returns are moving in the same direction and in the same velocity, speed. So it's very important that we have that correlation, good positive correlation. Now let's look at this chart of Bank Nifty and Fin Nifty. Both are in finance field, right? They also share certain stocks.
Yes.
And you can see their behavior is pretty much same.
Yeah.
Okay. Maybe slight variations here and there, but you can see here they have 98.5% correlation. It's like, we know that they are going to move in same direction, either upwards or downwards or sideways.
Just a silly question. Earlier you said -1 +1.
Yes.
And now this 98 point, that was also correlation, right?
Yeah. So 1 means 100% basically.
Okay. Yeah.
So 100% means 1. Okay, so 98.5% correlation is very high, and this is a perfect pair for pairs trading. Now here I am going to show two stocks which are like not correlated at all. LTIM and OFSS. And here you can see that's -6.5% correlation. So you can see their behavior is totally different. One is going up, the other one is going down. One was sideways, the other was going up in the beginning. So here you can clearly say that, okay, this is not a pair that I would like to do this strategy on. Now, you can also, let's say I want to choose a universe and I want to check the correlation between all those constituents, okay? For example, here we are going to check Fin Nifty constituents, okay? All the stocks and relationship between each other, okay? Let's say you have 10 stocks, 10 versus 10. What is their relationship? So as you can see here, all the stocks on y-axis, on x-axis, and you see their correlation. If Axis Banks versus Axis Banks, it will always be 100%.
Naturally, yeah.
Right? So now if you look at these clusters, you can see one particular set of stocks. Okay, here ICICI Bank, ICICI GI, and ICICI Prudential or Prudential Life Science. And you can see their correlation is much higher, above 90%. So just like Tata Motors, DVR, and HDFC Bank and HDFC. So similarly, this set of ICICI Bank stocks, they are like highly correlated. They are moving in same direction and with same magnitude. And there are also some other HDFC, AMC are also correlated with ICICI Bank and other stocks. So you have to check for these correlations and then choose the pair.
One thing, this correlation will depend on the time for which you are doing the study, right?
Yes. So for measuring this correlation, we are using 1 year data.
1 year. Okay.
Previous data. This is a UOD data.
So what I mean to say is maybe after 1 year, these 9 boxes which are green might not remain green.
Yes. Yes.
That is
the
that is
correlation can keep changing.
Yeah.
So they might be in last 1 year they're highly correlated. Maybe next year they're totally not correlated.
So some other pairs will become
yes.
correlated.
Yes. So we need to have at this current time a correlated pair. Then only we can move forward with that pair. And then we'll check for divergence, and whenever there is divergence between this correlated pair, then we do the strategy, pair trading strategy. Then I'll show you how to do. Now next one is a cointegration. Now this can be little bit statistical definition. So please bear with me. Cointegration is a statistical measure of two time series variables. Time series nothing but price versus time, right? It's a time series variables which indicates if linear relationship of the variables is stationary or not. Okay. In the cointegration, what we are doing is that we are looking at the spread between two stocks, and we are looking at that relationship between that spread, whether it is stationary or not. Okay. So here the variables that we are looking is the log prices of stocks A and stock B, and the linear relationship being a linear equation. Here you can see this is a linear equation defining the spread between log prices of stocks A and B. So here is a log of stock prices A, log of stock prices B. This is the linear relationship that we are looking at, the spread.
And what is N?
N is an hedge ratio.
Okay.
That is calculated to kind of normalize the data. So once we get this spread between these log prices of this price A and B and the spread, then we try to measure a kind of statistic value called as a augmented Dickey-Fuller test. Okay, which tells us whether a pair is cointegrated or not. I'll talk about what are those values and all at later point of time. So now you can see that there can be some pairs which are cointegrated but they are not correlated. So for example, Nifty, Bank Nifty, they are not cointegrated but they are correlated. Now 89% correlation. It's important that if you want very good results in pair trading, that it also needs to be cointegrated. Okay.
So basically, just to put it in layman's words,
yes.
Correlation is something which they move together at the same speed,
yes.
Whichever trend it is, down,
yes.
up or down.
Yes.
So in similar words, how can co-integration be explained?
Co-integration is it's like relationship between two stocks, and we are taking their prices and they're measuring that relationship using the spread. And then
so the spread is the difference between the two prices.
Those two prices, and we're looking at how the spread is behaving. Is it behaving in mean reversion manner? Like it is going up and down, or it is trending?
Okay, so this was a layman's explanation of the previous statistical formula, because that was PhD level stuff. So this
yeah. So basically, if there is co-integration, means it's kind of mean reverting.
Okay.
So the spread will kind of mean revert, and that is what we want.
So you want ideally something which is correlated and also co-integrated. Yes. So there is more of mean reversion taking place from time to time.
Yes. So now let's also look at another example. Axis Banks and PFC both are in finance sector, and they have both co-integrated as well as 90% correlation. So these are very good pair if one has to do a pair trading strategy. And here, just to have another difference, co-integration describes a long-term relationship between asset prices. Asset prices being the log prices that I talked about. Correlation describes a short-term relationship between returns. Right? We are looking at the returns. So that is one big difference between co-integration and correlation. Now coming to the mean reversion. Now if you look at a price and see what is non-stationary and what is stationary. Non-stationary means if a relationship between two stocks is trending, then that is non-stationary. Stationary means it is mean reverting. That the price, whatever variable that we are looking at, let's say spread between two stocks, whether it is mean reverting or it is stationary, that is what we are looking at. So for pair trading, we are always look for the relationship which is stationary and not trending.
Okay, so like I earlier said, there are two types of pair trading. One is the trend following. For that, you require that non-stationary kind of instrument.
Yes.
For this kind of pair trading, you require the stationary, which is the mean reverting pair.
Yes. Another good example is that sometimes Nifty, Bank Nifty have high correlation, right? Even after high correlation, sometimes when they diverge, they can trend for a long time.
Yes.
So that is why just using correlation can sometimes be risky.
Yeah.
So that is where these, mean reversion testing and
In fact, it I think happened in the last
cointegration.
6 months. Nifty was
Yes.
rising continuously, and
Yes.
Bank Nifty was in fact going down.
Yeah, one can be sideways and one can
Yes.
keep on trending. So that can be risky when you're doing pair trading strategy if you're only looking at correlation. So in that case, it's better to have at least more than one, like, correlation or mean reversion. Or if you have all the three, even better. But we'll come to a phase where we can objectively measure all of these things and then we take a decision. Now we can measure this mean reversion using something called a H-exponent, and this is actually used somewhere in 1950s in dam construction or something like that. But somehow they are using the same statistics in here as well. So it serves as this Hurst exponent serves as a criteria to select either momentum or means reverting strategy. So a Hurst value of 0.5 implies a Brownian random process. Brownian, if you see in physics, this is often talked about. Brownian random process means any given object is randomly moving. There is no purpose kind of thing, right? It's a Brownian movement. So when Hurst value is 0.5, there is random thing. But when the Hurst value between 0.5 and 1 indicates trending or momentum behavior, that there is some kind of purpose and it's moving in particular direction. That indicates that Hurst value, that whether the whatever mean reversion that we are testing, is it trending or not. Now Hurst value between 0 and 0.5 indicates anti-trending or mean reverting behavior of the time series. So this is what we want. When the Hurst value is 0, between 0 and 0.5 or less than 0.5, is that particular pair is mean reverting. So now we are measuring three different things. Ultimately what we want is that a pair is highly correlated, highly cointegrated, and also mean reverting behavior. Because if there is no mean reverting behavior and if they go on in momentum, then there is no point of
The trade will not pay.
because it's a mean reversion strategy. So we have to see that there is some mean reversion. So forget about all these values and all that. I'll come to how to do that.
Of course, don't think that you have to calculate all these things.
Yes.
Everything is been made
Everything has
objective.
been done.
So this is just a theoretical explanation of what has gone through making this tool.
Yes, so that you understand what is the thinking behind all these different values and terminology that we are using. Now finally, let's say our pair is cointegrated, correlated, and have a mean reversion property. Now I'm also going to talk about something called as the Z-score. In pairs trading, we convert distribution of spread. Remember we took that spread between two prices, right? The distribution of spread between prices of stock A and stock B into Z-scores. So what Z-score does in very simple terms is that you take a spread and we are measuring how far away this is spread from average spread, okay? Is it 1 standard deviation or 2 standard deviation from the average? We're measuring in terms of standard deviation. So you have a spread, and so it will have like this mean reverting behavior, and then we are trying to see if this spread is how far away from the mean, the average spread in terms of standard deviation. So you are measuring, is it 1 standard deviation away or 2 standard deviation from the average spread between these two stocks. So this Z-score is measured over 30 days. So
that is the standard 30 days.
This is standard all the time. So basically what it does is that whether there is a short-term divergence or in this spread from the average.
Just another silly question, because why I am asking silly questions is because some viewers will have this. No question is a silly question. That is what I always say. 30 days is 30 calendar days or trading days?
30 calendar days. It can be 21,
we
22
use
days.
in OPSTRA payoff graph, that is calendar days.
So now, as you can see here, just to explain the Z-score. Now if you go to 0 is your average spread, let's say. Now what is this Z-score is measuring is that how far away, this is from this your mean.
Okay.
So the closer to the means the Z-score will be 0.
Yeah.
The spread. Okay, so that is what we are measuring. So whenever this goes below -2 means 2 standard deviations away from the average or 2 standard deviations above average, that is what most of the time happens. That's when we are going to execute pairs trading strategy.
So after that the mean reversion will likely
to kick in. So we have to have those things that we need to know that pair is good using correlation, cointegration, or mean reversion. Once we know that is good, then using the Z-score chart, okay, then we can execute our trade. Now, see here, this is a Bajaj Auto and Tata Motors, same sector, automotive sector. Now, when it came below -2, we are long the first pair, first stock of the pair, long Bajaj Auto and short Tata Motors. That is a pair. And when it went above 2, then we short Bajaj Auto and buy Tata.
So that went from mid-June to almost mid-September.
Yes, mid-September.
3 months. Okay.
It can be.
So this is not a short. I mean, of course, it can be a short-term strategy, but we are talking about 3 months. So there will be rollovers also because these are future strategies.
Yes. So you'll get these multiple opportunities to enter, exit a given pair. Now, when we are going to execute, now we have all the knowledge that is required for pair trades execution, but when we are going to execute this? When the H-exponent value is less than 0.5, where we are measuring that mean reversion, when cointegration measured using augmented.
Yeah, this is just to simplify. H-exponent less than 0.5 because above 0.5 is trending category.
Yes, trending.
So this is less than 0.5 so mean reverting.
And again, cointegration also, whether it is cointegrated or not, when it is less than -3.5 with greater than 95% confidence. And correlation coefficient value is greater than 80%. Okay, we can adjust for these things as per one's observation, and then they can execute a pair trading strategy.
So all these 4 parameters should be in place, or there can be some.
There can be and or kind of situation what one can use depending.
That will come only with experience. I guess.
Yes. So Z score should be above +2 or -2, like 2 standard deviations.
I think that is very objective. To understand.
Yes, exactly. So now to make this objective, we made into a scoring system called a pairs trading scoring system. Now stationarity, where we measure that H-exponent, less than 0.5, we give a score of 1. But it is above or equal to 0.5, it is 0, right? If it is a momentum kind of thing, we are giving a score of 0. Now this CADF score with less than 3.5, confidence of greater than or equal to 99%, we give a score of 3. And if it has greater than equal to 95% confidence, we give a 2, score of 2. And greater than equal to 90% confidence, we give a score of 1. So higher confidence means higher score. Now if it is less than 90%, we don't have any confidence, then it is 0. Now correlation coefficient above 80%. Give score of 2. Correlation coefficient above 70%, 1. So now if the correlation coefficient is less than 70%, then we are giving a score of 0. So now based on this system, we can initiate pairs trading when the net score is above or equal to 3. So using all these 3 methods.
So basically all the 3 parameters which have gone into the formula and all these 3 possibilities finally are boiled down to just a single score. So that makes it more simpler and very objective.
So when net score is equal to 3 or greater than 3, then you can do pairs trading, and higher the better. And obviously the Z score should be -2 or +2 below. So now this is one of the screeners that we have developed to find these kind of scenarios. So this we call as a pairs trading screener. So here, as I said, we are measuring 3 things, right? One is stationarity. If there is less than 0.5 H-exponent, then it is 1. Then when this CADF confidence is above 99%, we give a score of 3. And then here correlation, it's above 80%, so gave 2. So the net score became 6. So this is the maximum value that you will get for any pairs trading strategy. Okay, so
effectively, whoever is looking at this screener has to look at the net score.
Net score, that's it. So now you can do a pairs trading with About India and Cipla, but the Z score has not come into picture yet. Okay, so there is not enough divergence yet for us to start that execution.
So that -0.2 should go to -2.
Yeah, -2 or +2 standard deviation. Then only we have to initiate.
So that means that though this is the topmost in the list, it is not meeting the Z score.
That divergence has not come yet. But if you see this between ABB and HA, the capital goods market segment. Now the net score is 5 and standard deviation of this Z score 1 is above 2. So now you can do the pairs.
This makes it very simpler. So just look at the net score and the Z score, and then you know that the first 4 are not to be traded as of now, but the 5th one is right to be traded.
Similarly, Cipla and Sun Pharma at the bottom. It has given another kind of pairs trading execution that one can do based on this. So it's totally objectified in terms of how you want to execute the pair trading. and you just look at the screener and you decide whether you want to do it or not. And as a bonus, now when executing a pairs trading, the notional of individual stock should be equal. So of the pair, if you take each stock, the notional value should be same. What I mean by notional value? If you take futures, you multiply the current price of future with lot size.
Lot size, yeah.
That will give you the notional
The value of the lot.
Yeah. So basically, that notional value should be same or very close, not more than 5% difference.
Yeah, plus minus 5%.
Otherwise, everything is in favor. But if there is a huge difference between the notional value, like 20% difference, it may not work out. It's important that that notional value is the same.
Now here, that doesn't mean you can't trade it. You can still trade it. What you can do is you can do that one lot each in futures, and the long leg you can add the number of shares in cash to make it neutral.
Yes, exactly. 2 or 3 things I'll say here.
Yeah.
One, you can utilize using cash market. That is one.
That can be done only for the long leg.
Yes.
Yeah.
You can do using options. Okay.
Oh, this is something.
This is something new.
Yeah.
I'm going to explain how to do that. You can do with options, or you can use multiple futures lots to normalize for it. Let's say use 2 lots in one and 3 lots in one.
Okay.
To normalize for that notional value. So you can use cash, you can use options, you can use futures.
But just since you said options, I immediately took it.
Yes.
How will you calculate the notional value in options?
I'm going to show with an example, so it will be much better
that will be
to
good.
understand. So notional value before normalization, let's just say example from some time ago. Bajaj Auto 250 lot size, 4644 is the price. So 11.6 lakhs. Tata Motors 8.13 lakhs. So there's a huge difference, right?
So 250 and 1425 was the lot size, and 4644571 was the market price at that time.
At that time. So as you can see, huge difference.
Yeah.
So you have to normalize for that notional value. Normalize means you're trying to bring it to close to each other. So now to do that, I need 2 lots of Bajaj Auto and 3 lots of Tata Motors. But here the issue is that the margin requirement increases.
Yeah.
So that's a disadvantage if you're going to normalize for the lot size. But sometimes people also, even with this difference, sometimes people do with single lot also. But my suggestion will always to go with normalization.
Yeah, so the value normalization is recommended but not strict. Yeah.
Yeah. Now, as a bonus, we have also done is that we also provided a backtesting for the given pair.
This is something amazing. I mean,
so what it does is that it looks at that pair. This is the top pair. I think one of the top pair we got Coal India and GAIL.
Yeah.
Here I only used 80% correlation, just correlation. Now you can see my entry into this is based on Z-score, and when correlation is 80%, just one factor in this case. So now, as you can see, I mean, even with
in the backtest you can pick and choose.
Choose how you want. Let's say I want to enter only if stationarity is there and cointegration is there. Cointegration also, there are 3 different values you can choose, and only then I want to enter this trade. So I entered this trade only with 80% correlation, which is a default in this backtesting. As you can see, it has given very good results.
And in that you have a single lot and normalized lot. So that also option is there.
So here you can do with single lot or normalized lot, and we'll see examples anyways.
And this backtesting data is
from last 2 years.
2 years, okay.
2 years of data.
And okay, I'm asking too many questions, but I'm sure when you say 2 years, it is 2 years from today. So let's say 1 year from now, it will be 3 years backtest.
Yes, 3 years backtest. So as you can see, you will see entry date, entry price, exit date, exit price, lot size at that point of time, and all those details you can see. So and you can see here it took only 21 days, and here also it took like 3 weeks. So it depends. Some can be much longer. You have to stay in the trade. And sometimes it can be short also. It totally depends how they are behaving with respect to each other.
So like I said, this is not for really small retail traders. This is something which is mainly for institutions or HNIs or even people who have a good capital size, not necessarily HNI, but then, for example, I mean, here we are talking about short Coal India and long GAIL in the first 2 examples. Sorry, in the second example. That over the period of May to July, which is just 2 months, it has given 1.73 lakhs of net PNL. But then you can imagine the capital required.
And here we have not added yet stop loss and target price also. We are going to add that. That will be another addition, like what should be the ideal stop loss. You can use 2% of average notional value of both the stocks, or you can use the absolute value, like say 20,000, 30,000, as per your risk appetite.
Another misleading, okay, not misleading, but people can misinterpret it. There are 5 examples of trade, 6 examples of trades here.
Yes.
Here, anyone will immediately see that all 6 have gone into profit, but
Yes,
that
it's not. It's not representative. Yes, that's a
so
good
don't
point.
say that Coal India and GAIL is to be traded permanently. No,
Yes.
because they have to meet the criteria first.
Yes.
But maybe they are more. I mean, they might be giving better results.
Yes.
As of now.
Yeah. There can be certain pairs which always give good results.
Yes.
There can be certain pairs, despite everything, even after meeting all criteria, some trades can go wrong.
So these 5 examples are just examples of what has happened.
Yes.
That doesn't necessarily mean that will continue to happen.
Yes, and we'll also talk about what are the pitfalls of all this, like why it can go wrong also. Oh, sorry. First, before going that, we'll do a demo of the application. So now you can find this app, okay, in both OPSTRA Definedge Securities and OPSTRA Definedge Solution. Okay, so now there is a new menu called Pair Trading menu, where we have 4 things. It's called a pair trading screener. We have a pair builder, and it's another novel feature. I think perhaps anywhere in the world, not just India.
Oh, it's
anywhere in the world. Yes.
First time in the world.
First time in the world, I will say. And then we have pair trading portfolio, and then pair trading archive. Much similar to what you have for option strategies, right? So we have done something similar to.
So portfolio and archive, the last 2 are something which you have already sort of done the trade or paper trade, and you are just moving them to, for future reference.
Yes, for future. So these are specific for the pair trading strategies. Okay. So first let's go to pair trading screener. So simply the first option is a pair trading screener. Now the first thing that you will see is that the index. Here we have made different sectors in this. We have made all. I'll talk about all a little bit later. We have Nifty and its constituents. Like what is the relationship between Nifty and its constituents? Like Nifty versus HDFC Bank, Nifty versus something. Is there any correlation between them or whatever? And then Bank Nifty and so far indices and its constituents.
So the main index and one constituent.
Yes.
That is the pair.
And also index itself, we have Nifty, Bank Nifty, Fin Nifty and all those.
But this cannot be done with an index which has no futures.
Yes.
I mean, not a metal index with Tata Steel.
No.
Oh.
That's why we have only
that's what.
those things. Now there are some custom my trading group, and I'll show you what are those, and then other sectors that we know which stocks belongs to in which
this
sector.
Is just a wild thought, again a silly question. If let's say since I read the word custom, you of course mentioned that they have to be correlated in terms of moving together most of the time, and you also said they should be from the same sector. What if for some reason, I mean no one knows why, but there are 2 stocks of completely different sectors but which tend to go together?
Yes, it's a possibility. It could be a coincidence, or they have some kind of another
maybe same
relationship.
Group, maybe same group holding. Tata Motors and Tata
possible.
Steel. I'm just
it's
giving a wild example.
It's possible. That's why we have that custom one for people who identified in their own way.
Exactly.
How they behave with one another. So let's say you can see this metals sector, and you can see the net score here. For example, NMDC and SAIL, they have good score.
So every column can be sorted, or only the net score?
Yeah, we can do.
Okay.
Here.
Yeah.
How much confidence you have? What is the correlation? It's better to do with net score because that's what based on which we are going to do. So the best one will be when the score is 5 and 6, and below that you have to be cautious. Use your own knowledge on how you want to execute this. Okay. Now there is another one. So instead of going to to each and every sector and all that, what we did that we have given an option called as all.
This scans everything.
It scans everything, but only sector wise.
Yeah,
so metals versus.
So there is no custom
metals.
in that. Yeah.
There is. It's not metal versus and some other sector. But metals and pharma, IT, like that. So that you don't have to go through each sector again and again. So in one place you get everything, so that you know what are the candidates that you can trade right away. So here there are many candidates, but the Z-score is not there. So here you can see Cipla and Sun Pharma is a pair that
Best,
you can
yeah.
trade. So if you click on Z-score, it opens the Z-score chart. Okay, so it plots that the spread, the standards, the spreads standard deviation.
Just like an oscillator.
Yeah, oscillator kind of thing, right? 2 standard deviation away from down and up. So if it is below -2, like it is given green color, right? Which means here we are going to buy the pay trade, which means buy the Cipla, okay, the first one of the pair, and short the second one, second stock. And if it goes above, which we are shown in the red, short the first one of the pair and buy the second stock of the pair.
So, I mean, since this looks like an oscillator, and
Yeah.
a lot of people might have been using stochastics and other things like
Yes.
which are an oscillator. So there is a trading strategy where, for example, stochastics
Yes.
goes to 90 and then starts coming down, and only below 80 you short it. Is there something like this over here, like
Yes.
below -2.2, and
Yeah.
then when it goes up?
Yeah, you can do that. So you just look at the screener whenever it goes above 2, wait
And then it
till-
starts coming down,
When it comes down, you can start. So that is, for example, here it went above 2 and went up to 4,
Oh, yeah, 4
5.
point, yeah. So there the trade would have failed.
That would have failed if you have entered at that point of time. So this is where that custom knowledge,
Some
that you have
experience is
acquired
required.
experience.
So basically, just don't take the trade just because the Z-score is
Yes.
in the extreme. Who
Yeah.
knows, it might go up further.
Yes, rarely this happens. In some stocks it can happen, but 2.5 is good enough score for most of the stocks. But there can be exceptions where it can go up to 4, 3 also.
In this list of stocks for backtesting, there will be some stocks which were, like you said, 2 years. There will be some stocks which were not in futures maybe 2 years back.
Yeah.
So does it still
In that case,
how do we-
it will only for short. But whenever both of them are there,
were in future?
that period it will be. So here you can see, you can backtest this, for example. So this is also good, just with 80% correlation. So this is just with 80% correlation, and if we can include stationarity as well, okay, and then what if we increase cointegration? So with all the 3 filters, it is not coming. So you can change, for example, here 2, for example, because sometimes what happens is that you don't get that cointegration.
Yes, it will
up
not
to
match all
3.
3. Yeah.
So see, with this score, like this is 1, this is 2, this gets a score of 2, 1, 2, 2.
So just to explain the backtest results, Cipla entry date, entry price for each of them,
Yes.
exit date, exit price for each of them, lot size, lot quantity,
PNL, individual
and,
PNL.
Okay, what was the PNL for Cipla, what was the PNL for Sun Pharma, and that's the total.
Yes, yes. So here the entry happened in somewhere here, August 30.
Yeah.
And then see here in this case, it is just 26 days.
Yeah, because see, we explained the entry. I don't think we have talked about the exit.
Yeah. So here it is. Earlier it was single lot. Here with normalization.
That same 97,000 might become 1.82 lakhs.
1.82 lakhs. So that's why.
But of course, this will be more capital intensive because now we are
Yes.
talking about 3 lots of Cipla and
Yes.
5 lots of Sun Pharma.
Yes, yes. So now the entry criteria, we said Z-score of 2, right? So we are given up to 2.5. So you can go up to 2.5 and backtest it. That is one way. Because these are rare, we are not gone beyond 3 and 3.5. And exit score is SAR. SAR means stop and reverse. So in this case, it goes above this, we stop. If you have already entered somewhere here, we stop and reverse that pay trading. If they have that this thing.
Oh, you mean if it is, let's say, long Cipla and short Sun Pharma, where it goes to stop and reverse, you do the opposite.
Yeah, you do the opposite only if those criteria are still met.
Yeah, you have to still check those criteria.
That net score is above 3 or 4. So using that, using that information, we can change, and you can also look at what was the correlation, cointegration, and stationarity historically also. So all the data is there using this, which you can test.
Yeah, I think the out of these 4, बाकी के जो 3 है वो थोड़ा again high level PhD stuff लग रहा है. So Z score is the one which is easier to understand.
Yes. So you can backtest different ways and see what works and what doesn't work. Maybe some pairs are very good, but they may not give good historical results. So maybe it's better to avoid those kind of pairs. So now let's say I got a good pair, right? Cipla, Sun Pharma.
Yeah.
Maybe I want to initiate here. Okay. Now I can go to pair builder. Now we are going to see the pair builder.
So it goes to the pair builder.
Yeah. So for the first time, we are introducing pair builder anywhere in the world. So basically, what it does.
So this is like the strategy builder in OPSTRA or in
Yes,
options.
it's exactly like strategy builder, where you can add futures of each one of them. So let's say I want to add long Cipla, and then you select the Sun Pharma, and then you add
Short.
short. So this is how it looks.
So the margin required will be 3.25 lakhs.
Yeah,
So because
3.25 lakhs.
this is not a hedged trade in that sense.
Yes.
So individual margins will be considered for both stocks.
Yes. And here you can see we also provided a notional value of futures. So we can look at this notional value and then we can change. We try to match that notional value using options, or we can use cash, or we can use multiple lots of variable number lots of futures. Okay. So this is how that payoff chart looks like. So remember this. This looks slightly. This is slightly different from option strategies.
Yeah, this is not the
that you
options
do.
payoff.
It is slightly different. So this underlying is the x-axis is actually the price change, and not the underlying price alone.
Yeah.
Okay, and on the left side or the y-axis is you have
PNL.
PNL, and you can actually scroll and see what happens. Let's say both of them go up by 1%. Okay, then so here let's say 1%, 1%. Yeah, roughly 1% here, right? So what will happen is you will lose 6,000 in Sun Pharma and you will gain 9,620 in
Cipla.
So your total PNL will be 2,896. Okay, both have to be same, exact same. Because in x-axis we cannot have two different values.
Yeah.
So we have to always see by that same change. So what we
But that is very unlikely to happen. I mean,
Yes.
Almost like impossible. Like
Yes.
Sun Pharma and Sun
Yes.
Cipla are both exactly 1% up.
Yes, exactly. So to avoid to those who want to see, like let's say something has increased by this much and something has the stock B has decreased by this much. So we made a 3D payoff chart. So this is a little bit heavy, so take some time. So in 3D payoff chart, actually you can see if it goes up by this much and if the other stock goes down
So you
by
can
this
play
much.
with each of the
Yes.
leg.
Yes. So here you can see to zoom out.
You said it is heavy only till it plots, right?
Yes, till
Once
it
it's
plots.
plotted, then it is smooth.
Yes. So here you are seeing Cipla. Okay. And here you are seeing Sun Pharma. Right? So and here we have plotted the at the money prices.
Yeah.
So now you have a Z, depth of Z. So what Z is that? Like what is at different prices of, let's say in this case it will be Cipla in different Z depth at different Cipla prices. What will be the PNL at different Sun Pharma prices? So you have to have a 3D kind of imagination to understand this. So let's say from here, this is center point, right?
Yeah.
Somewhere it will be close to 0, something like that. Somewhere here, right? Now let's say Sun Pharma goes up by 1% and Cipla stays at the same price. Then what happens? So where is Sun Pharma? Yeah. So Sun Pharma went up, right? So
this is a slightly complicated part because it is 3D. So maybe you will require more time to really work on it and understand it, because that is the only way to understand, by using it yourself.
Yes. So Sun Pharma went up, but Cipla went down. Let's say. Yeah. See here you can see underlying PNL.
Yeah.
So it's a negative, like that. So here you are seeing the price 1911 and Cipla is 1612.
Right.
And it is showing the price. So like that you can see. So scroll around and see what is how to check what will be the PNL under different price changes. Okay. Now another thing, remember that we have different notional value here, right?
Yeah.
So how we are going to bring to the same notional value? One, I said use two different lot numbers to achieve that notional value. Here we have initiated a new method whereby we are going to tell which option, delta option, we have to short or buy to neutralize that notional value, normalize that notional value. So here we are selling based on the delta, we are saying that add 58 delta to Sun Pharma.
Okay.
Okay, minus 58 delta to Sun Pharma. So you go to option chain and see 58 delta. Usually long option.
Yeah. So this is
Long
short
put
Sun Pharma,
option.
so you have to buy the put, which is 58 delta.
Yes, 58 delta.
Yeah.
So let's say 54 delta.
Yeah.
Arvind Cipla or Sun Pharma? Sun Pharma.
Yeah.
So let's say 58 delta. So usually
Yeah.
here this one.
Yeah.
Here, sorry. Yeah.
Huh.
Put delta 58 delta. Right? So here this one
We have
is
55, 1960 put.
1960 put.
So you
we
buy
are
that.
going to buy. Okay.
So now it becomes value neutral.
Yes. Now your notional value, see, it's the
Yeah.
same. So
Right.
now PF chart will look like something like this. It has changed.
But then
slightly.
this is valid only for that expiry, and then again the number of days to
Yes.
expiry plays a role.
Yes.
And then you when you roll over the futures, you'll also have to buy.
Yeah,
the
again we have to measure the notional values. Yeah, it is little bit complicated, but that is how if you can reduce. The best another alternative is that you simply buy in cash.
Yes.
And we are going to add that cash capability as well in this.
So that is true for the long leg, where
Yes.
for some reason because of the value neutral thing,
Yes.
if the the long component is less,
Yes.
then you can buy that much value in cash, number of
Cash,
shares.
yes, yes.
There is no rollover in that. Then that is the
That is
easier
it will
method.
stay there. Yes. So that's how we are going to do, and then you simply save it. Okay, Ciplas and Pharmasa strategy like that. Okay, so you simply save it, and then you can go and look in your portfolio,
Okay.
and it is saved, and you can come back and check.
Oh, this is like the any option strategy.
Yes, exactly. So that's how we do. So this is how you are going to use the pair trading strategy. And finally, we also have to look at what are the advantages and disadvantages.
Yeah.
So advantage is that there is no directional risk. So either if it go up or down, doesn't matter. Lower max drawdowns because there is inherently they are hedged.
Yeah.
So because of that, inherent hedging of risk is there. So you'll have low max drawdowns and profitable irrespective of market rate.
Right.
So it doesn't matter market is up or down, it will work. And finally, what are the disadvantages? Higher margin requirement because you have to, if you are going to do with futures, it can have higher margin requirement.
Yeah, like it was 3.6 lakhs in
Yes.
Ciplas and Pharma.
Yes. Ideally, if you are able to short in short market, it wouldn't have mattered much. But because we cannot short in the cash market, we are depending on futures market, and then fewer opportunities. Like because of Skinner, you will find more opportunities. But in general, people were maintaining these Excel sheets and all that, so difficult to find opportunities. But now that situation will not be there anymore.
Yeah, in fact, earlier people, I know some people who do only pair trading, so they used to do only some favorite pairs and they used to study them.
Yes.
But now they can expand to
Yes.
different pairs because it is just one click away.
Yes. And then there is a risk of stock events. So let's say we doing a pair trading strategy. Suddenly some bad news came in one stock, not in the other one. So that can have effect on that stock. And if you're lucky, it can
It
also
might be in
go
your
in your
favor.
favor. If you're unlucky, it can be in opposite one also. So these things can happen in pair trading strategy. So you should be ready to face that kind of risks. And finally, pair trending. Like we have shown that Z-score example, after -2 it went up to 4. So there it is trend.
That is
there
a
is
risk.
trending.
But that happens very rarely, you say.
Rarely, yes, it can happen rarely.
But अगर किसी का bad luck ही खराब है तो you can't help it.
So overall, this is the whole tool that we are providing. So go and check it out and study a little bit, observe them a little bit. Don't directly jump and do pair trading right away. So have some experience in this, observe them, and then go for.
No, in fact, there is a lot of work which needs to be done for people who are new to pair trading in terms of backtesting. Select your favorite pair, but at the same time, keep it in mind that just because they have worked well for the last 2 years doesn't mean that they will continue to work well for the next 2 years. So what you can do is just observe them by saving those strategies and see how they move.
Yes, yeah, that's a good example.
Yeah,
If
like
you
the paper portfolio.
Yeah. So let's say some pair went up to -2, -3 Z-score, and it has a good net score, total score. then you save in your portfolio and observe. Then you'll get a confidence. Okay, so this is how you have to approach pair trading. So yeah, AP. So that's all.
Yeah,
we
this is
have.
an excellent tool. Like you said, in fact, I was under the impression that this is first time in India, but I got a pleasant shock when he said it is first time in the world.
Yes.
So that is huge piece of news for. I mean, every single trader in India should be proud of that. This is something which is introduced for the first time in the world,
Yeah.
and we are sure that it will help you. Even those people who have never traded pair strategies, they can explore this strategy. For people who have been trading, even institutions or HNIs, this will be a great tool to help you in identifying pairs and make your job much simpler. And I believe this is part of the OPSTRA Pro feature, and there is no extra cost to it. So as long as you have OPSTRA Pro, this is part of the OPSTRA Pro package.
Yes, I just want to add one more point, and this is something we have not explored yet. You can also do different kind of option strategies, just option strategies, pair option strategies, and this is something one can explore.
And just one question: when you have a Demat account with Definedge Securities and you go to opstra.definedgesecurities.com and run this, is the trade also executable from the strategy builder like options?
Yes.
So
you can
from there
execute
itself you can initiate the trade.
Initiate that.
I mean actual trade, not paper trade.
Yes.
Okay, so this was a huge eye opener for me also, because I am used to pair trading. Whatever I mean, I have known some people who do it. They do the trend following method, but this is a completely different method, which is the mean reversion method. Both have their pros and cons, and in fact, I would suggest, if you are used to pair trading in the trending manner, you can also have this, which will automatically be cushion your any whipsaw in the
kind of
trend following,
complementary.
complementing. Yeah, so that can be a very good trading strategy in itself. One trending trend following pair trading and one mean reverting pair trading.
Yes.
And if you get both in the same sector, nothing like it.
Yeah.
So yes, so I think this was just an introductory session, though quite long, but for anyone who's interested, it is extremely interesting. So this is this is already launched on OPSTRA. So now what you have to do is you have to work on it. So because unless you really understand the subject, it is not prudent to start trading based on that.
Yeah.
So spend a few weeks, maybe a few months to understand how it works and how the trade goes. Like I said, save it in the portfolio, and only then start actually trading it. Okay. So thank you and bye bye.
Thank you. Bye.